All right. Just want to welcome Brady Mullen, see his presentation. Toby and I have seen this before, so we wanted to share it with everybody we possibly can because it's eye-opening. So take it away.
All right, thanks, guys. I'll share my screen and we'll get going. Okay, so my name is Brady Mullen, and I have a little bit of a bit different background. I wasn't in the mortgage industry for 20 something years. I was actually a financial advisor and accountant for 18 years. And about 15 years into that career, I wanted to advise on real estate. I was buying real estate. My best clients were buying real estate in addition to other things. I was helping them with their other stuff. And I wanted to incorporate that with my financial practice. And there's a reason why you don't see a lot of financial advisors doing that. There's a big compliance mess when you try to make that happen. So I recognized that I was kind of stepping into some gray area. So I called my compliance team and I said, "Hey, I want to add this. I know what I'm doing here. I want to add this to what I do for clients." And they said, "You can't do that. You can't help the firm's clients invest in real estate." And my initial cynical reaction is like, are they're jerks because they're not making any money, so that's why they're saying that. And there may be some truth to that. I don't know, but they also gave a pretty good reason, which is like our compliance, like our legal CYA documents don't cover real estate, and real estate is in almost every case a pretty big decision, right? 6 and 7 figure decisions. So they just did not want advisors helping people advise on real estate investing because their liability insurance and their structures to manage suitability for clients just couldn't capture that. It's also because real estate is not fungible, right? Every real estate transaction is different, so it's really hard for them to put it in their box all over the country with their advisors. So, long story short, I tried to make that work for a couple of years, and I ultimately sold my practice to some friends of mine in the industry and started working in real estate. And the reason that I felt really strongly about this is I just noticed there's not a lot of codified, structured ways of calculating real estate unless you're doing big commercial stuff and you have a big accounting team that's working for you. There's just a lot of miscommunication and misnomers and misconceptions about rates of return on real estate, tax advantages. I mean, we all know people that make money by investing in real estate and have done very well. But we still hear people in the financial world saying, "Oh, you don't want to buy real estate because then you're going to deal with tenants, toilets, and trash." And I know people that are worth, you know, 8 figures who they don't touch toilets and they don't screen tenants and they don't take out anybody's trash. So I think that's just a good way for financial advisors to try to discourage people from investing in real estate. And not all financial advisors do that, by the way. I'm not painting that whole industry with a broad brush because they do helpful things. I think there's some tax strategies that they're pretty good with. They're good at seeing the whole picture. So I'm not dissing the financial advisory industry. I'm just saying it generally doesn't touch much on real estate, which I find a little bit strange because the choices that we make about real estate in our lives, even if we're just talking about our own dwelling, our residence, it's one of the biggest financial decisions that we make. And financial advisors typically don't talk much about real estate. So I came to this industry to try to bring some of the tools from the financial industry because they have really neat and sophisticated tools and apply those so that people could see how the choices in their lives that involve real estate affect them financially. So I do a lot of courses about renting versus owning, about investing, about retirement account investing, about upsizing, buying vacation homes, things like that. But this was kind of the flagship of why I started in the industry, was to talk about real estate investing. So as a financial advisor, I got this question a lot. People would ask me, what should I be investing in? As if a financial advisor has a crystal ball and can tell you, oh, you should buy this today because it's going to go up. Nobody can consistently do that. I've been, in my younger years, I thought that, we could figure out the secret sauce. And then as I got more and more experience in the industry, I came to the same conclusion that most veterans in the industry come to, which is like, you can't outtrade the market consistently over a long period of time. And there are people that will do it for a few years and then their system breaks down or it falters, and it's just not something that I believe can be done long term. So as a financial advisor, people would ask, what should I invest in? And the best answer to that question for a financial advisor, if they know what they're doing, should be, that depends. I need to know a lot more about what you just said before I can recommend any even category of investments, let alone a specific one. And so I created a list, and I call this like the priority list. So I would need to know, if somebody were to ask me, what should I invest in? My response would have been, well, I need to know, what kind of time horizon do you have? How comfortable are you with volatility? Do you need it to be tax sensitive? Do you need it to be liquid? Is it for income? Like all these things, we need to prioritize these things because there's no single investment that's going to do all of those things perfectly, not even real estate. And we're going to be talking about real estate. And so just as a way of understanding what I mean here, and I won't go through each of the categories, but just as an example, is there upside potential in stocks? Sure. I know a lot of people that got wealthy in stocks, and that's where they store a lot of their wealth, which is great. It's classically unstable. The market itself is out of your control and it's very volatile. So that would be the second one. Then there's liquidity. Publicly traded stocks are very liquid. You can buy them and sell them. I sold and bought a position today, and it took me like 3 minutes and a couple of mouse clicks. So it's very liquid. You can turn it into another form of wealth very quickly, or cash. You can do a lot of leverage with stocks if you're willing to take the risk. It's much more risky than what we consider leverage in real estate, but you can use margin and you can use options to get leverage in in stocks. So there's leverage opportunities, and you can also use stocks for income, but it generally doesn't produce a big income. And stocks historically, we're just keep going down the list. Historically, they've been a pretty good inflation hedge, but it's not a tangible asset. So it's got a half mark there. It can be very tax efficient if you intend to do that. So buying and holding stocks, if you're just buying and holding, it's actually very tax efficient. But not, that's not what happens a lot of the time when people buy stocks. But if that's what your intention is to be tax efficient, stocks can be very tax efficient. And then insurable. So a stock portfolio isn't an insurable asset. And for any financial people watching this, I know I'm broad brush stroking a lot of these. There's a lot of nuance in finance in general. So I know that there are some nuances here, and this isn't an exercise in getting perfectly accurate about all the different asset classes. But generally speaking, that's how investing in stocks works. There's a profile for bonds, for cash, for fixed products, fixed insurance products like whole life insurance or equity index life insurance and annuities. They've all got some strengths and some weaknesses. They all do things well. They all do things poorly. And this is essentially, again, broad brush stroke here. This is essentially the toolbox of financial advisors. And there's nothing wrong with that per se. I don't have an issue with the financial advisory industry. I have a little bit of an issue of people in that industry calling themselves holistic because they're missing a major asset class, which is real estate. They just don't talk much about that. But I do believe that they do relatively good things for people, at least the good ones. But here's this asset class that financial advisors barely touch, except maybe in the form of like traded or non-traded REITs, or tenant in common, or TICs, or you know, Delaware Statutory Trust, DSTs. Sometimes they'll play in this arena a little bit, but it isn't the same. Like a REIT is not the same as real estate ownership. A REIT is more like you're owning stock in a company that makes money by buying and selling and managing real estate. It's not the same as owning the real estate yourself. But anyway, there's this asset class that isn't perfect, right? You'll see that real estate is classically illiquid. That doesn't mean that you can't sell it if you need to, but it takes a little more time. It can be pretty costly to transact in real estate. So it isn't considered a liquid asset. It's generally less liquid. But as far as like a total profile goes, it's very good. It's got a great upside potential, which is the opportunity. It's more stable than the stock market, less stable than cash, obviously. We already talked about liquidity, but it's classically purchased with leverage very, very often. It creates great income. It's a great inflation hedge. It's very tax efficient, and it's an insurable asset. The reason I don't give it a full mark in insurance is because like an annuity or a life insurance product or even cash in the bank, your outcome is insured, right? Where in real estate, you invest in real estate and the property might be insured, but your investment return is in no means insured. So your performance in real estate is not an insured performance, it's just an insured asset. And then there's one priority that I kind of made up because I never thought about this as a financial advisor, but I think of it like the inside knowledge advantage. If you're an aggressive real estate agent and you're looking for people that are looking to get out of a transaction quick, or maybe there's a family quarreling over an estate of a parent or a grandparent, and they're just looking to dump the property. That's not public knowledge, but good agents can find that stuff and negotiate that to the advantage of the investor or themselves if they're the ones buying it. So Real estate is the only thing that works that way. And I'm not a fan of taking advantage of people, but what I mean is, if somebody really does want to dump a property and they're looking to get away, that's just good business to recognize that and to use that in the negotiations. And then we're going to spend some time now talking about the returns in real estate, like the upside potential, the opportunity. And this is where I think it's not fair to just put right this little dot here. I think there's something to be said for the returns in real estate are probably a lot better than people think when you calculate it all together, which is what we'll spend some time doing. Before I do that, I want to throw in another thing that's often um, either unknown or just simply not talked about much in traditional financial circles, which is that you can own investment real estate inside a retirement account. And that means an IRA, that means a 401k if you're controlling the 401k. So if you work for, Lockheed Martin or something, they're not going to let you buy real estate with that money in there until you retire or move the money out. But you can buy real estate in an IRA or a Roth IRA. It can own those things. And sometimes when I talk about that, people will ask, like, do you mean taking the money out of the IRA, paying taxes, maybe a 10% penalty? Because if you're under 59 and a half and you take money out of an IRA, there's a 10% penalty. There's a few exceptions to that, like if you're using it to buy your primary residence. But in general, people want to know, do you mean taking the money out of the IRA, paying those fees and taxes possibly, and then using the rest to buy real estate? And while you may do that. It's not illegal to do that. You could do that, but I'm not talking about that. I'm talking about the IRA itself owning real estate as if that real estate were a mutual fund or an ETF or any other product that IRAs traditionally own. The IRA it can be the owner of a real estate investment. So in that case, the property is titled in the name of the retirement account. So it's the retirement account that owns it. You don't have to distribute the money out of the IRA. It's the IRA that owns the property, and tenants actually pay rent to the retirement account. And now in many cases, people will create an LLC that is wholly owned by the retirement account. So in many cases, the tenants don't know that it's a retirement account that owns the property because it's not really their business. But sometimes retirement accounts own the property outright, and the tenants literally pay a check to, Toby Hansen's Roth IRA, and that's where the rent goes because that's the owner of the property. And this may sound like something that somebody who's skirting the law might do in, Oklahoma or Texas or something, but this happens thousands of times a year all across the country. There's a big community of people that do this. They'll buy properties with a Roth IRA, and the income is tax free, and any growth that you realize is tax free because the income doesn't go to the investor. The income goes to the Roth IRA, and so once it's distributed, then it's the investors, but it's not a taxable distribution if it comes out of a Roth IRA. So my point here is not that everybody should go buy real estate with their retirement accounts. It's not right for everybody, but it kind of bothers me that so few people know that this is even an option. And a lot of times if I'm talking to a sophisticated group of investors, I'll mention this, and inevitably somebody will raise their hand and say, why would you do that instead of just buying the real estate outside of the retirement account because it has so many tax benefits already when you buy it outside of the retirement account? And my response to that is that I actually agree with that. But I don't think in terms of buying money or buying real estate in a retirement account because I want to own the real estate in the retirement account because it's the best way to own the real estate. I think of it in terms of it's a good way to diversify what you have in your retirement accounts. Most people have some combination of stocks and bonds and maybe money market or something very cash like in the retirement account. And we've seen an environment lately where all three of those things suffered at the exact same time, and people are realizing that that's not a perfect combination of assets, right? Cash suffered because of high inflation. Stocks were very volatile lately, and that happens cyclically, like that happens regularly. And bonds have been unusually volatile because a rising interest rate environment is not generally good for bonds. And so all three of those things capitulated at the same time, and people got pretty nervous about, whoa, I thought the bonds and the cash were supposed to be a hedge against the volatility of the stocks, and it kind of wasn't. And there's a reason for that, because when we think of non-correlated assets, what they mean by that in finance is not that they ebb and flow exactly at different times. They just have their own rhythms. And so sometimes those rhythms will align where they all happen at the same time, good or bad. And sometimes they'll be off, and sometimes they'll be distributed, and sometimes they'll be all at the same time, good or bad. So adding real estate to that mix gives you another way to diversify. It gives you we looked at that chart earlier that shows the profile of the different asset classes. And real estate's a fantastic diversifier because it's so different than all the others. And you have a lot more control over a real estate portfolio as well. So the whole point here isn't that you should definitely buy real estate in your retirement account. The point is you should consider that as an option because it's an option. And if it ends up not being right for you, then that's fine too. But it's odd to me that this isn't talked about more than it is because it's a very common thing. Sometimes people will ask this question, and I think this is some sort of polite way of asking something like, is this a loophole? Is the government going to shut this down? But this has been going on for decades and decades, many decades. Um, so the rule, what the IRS states is the rule for what you can and can't own inside of an IRA is a list of 3 things that you cannot own. You can't own collectibles, so you can't put, you can't put art. You can't own an investment in art in an IRA or a Roth IRA or rare Spanish coins or old classic Corvettes. Those are collectibles. You can't own them in an IRA. You can't own S corp shares. So if you want to own businesses, they need to be C corp shares, and you can't own life insurance. Those are the only 3 things that the IRS says you can't own this in a retirement account. In fact, you can do a lot more, you know, creative things than just owning real estate. I've seen people do hard money loans outside of or in retirement accounts. I've seen people do, buy tax liens. You could buy precious metals and own them in retirement accounts. There's all sorts of things you can buy in there. But of course, the Fidelities and the Vanguards of the world, they have no interest in informing you. I don't know that they're particularly trying to hide the fact that you can do those things. That's just not their business. They make a quarter of a penny or whatever every time you make some trades, and they fund a pretty big empire because of that. They have no interest in you buying real estate, but there are custodians all over the country that will help you do that. It's a pretty straightforward process. So sometimes people ask, why is nobody talking about this? Is this some sort of loophole? I've learned to answer that question with another question, which is like, who are you expecting to tell you about this? Like, is your financial advisor going to tell you how to buy real estate in your retirement accounts? Probably not. CPAs don't generally give investment advice because there's liability there and they don't want that. So maybe family and friends, if you have family and friends that are doing it, that you may get some information there, but most people don't know this can be done. And so really it's the real estate professionals that are sophisticated in helping people invest. That's where the resources are. So that's just something I like to bring up in the sense that it's something worth knowing is possible. Not that everybody should do it. It's just that you should know that it could be done so that if it's something that makes sense for you, you know that that's an option. So let's talk about returns in real estate. And by the way, James and Toby, if there's anything you want to say or interrupt, if anything's not clear, just chime in because I can ramble sometimes.
Oh yeah, the wheels are turning. I'm taking notes, but yeah, I'll jump in. Thanks.
All right. So this is an example that I share, and I've hidden her name. This is a real conversation that I had with a woman. It's been a couple of years now, but I call her Jill in this story. She was a Pilates instructor. I had injured my back, so I was doing some Pilates to try to strengthen some things. And we got talking, and she asked me what I do, and I said I help people invest in real estate. And she said, "Oh, my husband and I invested in real estate, and we didn't really make any money. That was kind of a bad experience." And I said, "Well, tell me about that, because that's certainly possible. I want to know what happened." And she said, "Well, we bought a 3-2 townhome in the Seattle area, and about 6 months later, my husband got a job offer in the Denver area, which is where they live now, and it was just it was like a dream job for him. It was a great offer, and so we decided to move." But we decided to keep the property because we didn't have enough equity in the property to sell it so quickly after having purchased it without bringing more money to the table that we didn't have at the time. So they ended up accidentally kind of investing in real estate. And so I asked her more about it, and she said, we purchased it for $200,000. And she said she didn't make any money. Now, I started to suspect that what she meant by didn't make any money was that they weren't cash flowing very well, that can be pretty common if you're obviously she put very little down because she didn't have enough equity to sell the house when she left, so she needed to keep it. So I assumed that she used like a 3% down, like first-time home buyer, or 3.5% for an FHA minimum. But she claimed that we didn't make any money, and I said, "Well, what about when you sold it?" And then kind of her demeanor changed. She said, "Oh, well, when we sold it for $400,000 10 years later." And now Jill, I really don't want this to come across as me condescending and portraying Jill like she's not smart, because she was smart. She knows things about physiology that I don't. Like she was a smart and bright lady. And but I think the reason I share this particular story is because it's a very common mistake for people to make, to focus only on the income in a real estate investment. And of course, income isn't unimportant. It is an important thing, but it's not the only thing. And she knew right away when I asked her, like, "Hey, Jill, you recognize that's the same investment. How can you tell me that you didn't make any money when you sold it 10 years later for $400,000?" She goes, she knew the answer. Had somebody, if I'd asked her exactly, "Did you know that that was the same investment?" She obviously knows the answer to that question. It's not a difficult leap to make. But in so many cases, our intuitions, they separate those things. We think of income as one thing, and then when we sold it later, we felt like, like that was a different thing, and we don't connect those things. It's a really common mistake for people to make. So the first mistake that she made in my mind, that which is a really common thing, is to say that we didn't make any money on that, which is kind of what I just explained. But her next mistake was this comment here. So she said she bought it for 200, sold it for 400 10 years later, and told me, "Gosh, I guess, when I said, that's the same investment." She goes, "Well, oh yeah, of course it is. I didn't really think about it that way." She said, "I guess we did okay. I guess we doubled our money," which is a big mistake, right? She did a lot better than doubling her money, because she didn't put down 200,000 and leave it there for 10 years and take out $400,000 later. She did much better than that. So I started digging into it with her, and I said, "Well, how much did you actually put down in the property?" And I knew that she had used a loan, because she would have cash flowed had she purchased it cash. And I kind of suspected that she didn't anyways, because that's rare for people to buy their first home with cash. But she said they put down 3.5%. So they used an FHA loan at 3.5%. I threw in an estimate of closing costs, and I said, "Is it fair to say that you put about $10,000 down on that property?" And she goes, "Yeah, that seems about right." And then I'm assuming that it was cash flow neutral, because she told me that it was. It's also true. I asked her if she kept books on that property, or if she just, if it was kind of loosey goosey. And she said, "Yeah, we took the rental from the tenants and put it in our joint checking account. And when there were bills to pay, we paid it out of our joint checking account," which is not, I mean, that's not illegal or unethical to do. It's just not a very good business practice, because then you don't really know what's going on, and it's hard to analyze it if you can't separate the expenses and the revenues. But so we'll just have to take her word for it that it was cash flow neutral. So she put in $10,000. She walked away 10 years later with 250,000, because by then the debt had been paid down a little bit, and it had appreciated by an extra 200,000, all of which belonged to her and her husband. So she walked away after expenses with $250,000 in her pocket. So she didn't double her money, right? She turned 10,000 into $250,000 in 10 years, which is like a 33% annualized rate of return, or internal rate of return, if you want to call it that, which is phenomenal. That's a fantastic rate of return. And then this was kind of, in my mind, the third mistake that she made. But again, I don't mean to be harping on Jill here. I use this story because she made she made all of the common mistakes that our intuitions tease us with, all in one relatively short conversation. So at the end of that, when I pointed it out and I just ran that quick annualized rate of return number on my phone, she put in 10,000. 10 years later, she had 250. I showed her the rate of return, and her response was this next statement, which is, "I guess I got pretty lucky." And that's the third mistake, because my response to her was like, "Jill, that's just what happens with real estate. That's just how it works. You use leverage. Appreciation plays a huge role in real estate investing." Now I will concede there is one way in which her experience in real estate investing was unusual, which was that she bought an investment property with an FHA loan. You can't really do that intentionally. Now, she did it above board because she was intending to live there, but she didn't live there because something came up in her life. But that's not something that you can iterate over and over and scale. So she got pretty lucky in that she bought an investment property with only 3.5% down. But as far as the appreciation goes, going from 200 to $400,000 is not that unusual. It's good, but it's not unusual. In fact, it's pretty average for metropolitan areas. People talk about national averages, being like 3 to 5%. But you have to remember that those national averages are being pulled down by places in nowhere, Indiana, and being pulled up by places that people are congregating to, aka cities. So 7% in a metropolitan area is not an unusual appreciation. Again, it's good, but it's not unusual. So she didn't really get lucky, except that she had an FHA loan. And I guess you could say that she also got lucky because she sort of accidentally invested in real estate. Had she been able to sell it when she left, she probably wouldn't have had that experience and put $250,000 in her pocket 10 years later that would have been really hard for her to duplicate otherwise. So the reason why that is, and I think we kind of see this, but I want to graph it out. If you buy a property worth $500,000, I'm using that because it's just a simple number. If I buy a $500,000 property and I put 100% down, or $100,000 down, excuse me, then and I have a $400,000 loan. Now I know there's some details that I'm sort of glossing over, like closing costs and things like that, but I want to talk about the concept here. So I'm sort of making this simpler. If I have $100,000 down, that's my investment. I have a $400,000 loan. If that property appreciates by only 5%, that property is now worth 525. The debt's been paid down by about $6,000. That's what you see here. I turned $100,000 into $131,000 in 1 year, and the asset only appreciated by 5%. That's a 31% rate of return in 1 year, while the asset itself only appreciated by 5%. Now, of course, leverage can work both ways, right? Had the property dropped by 5% instead of gone up by 5%, which can happen. Maybe it dropped by 10%. That's going to dig into my investment pretty hard because it's happening all at the top there, all on the equity. However, if you're buying real estate and your intention is to hold it for a while, that smooths out the returns pretty significantly, right? It's pretty difficult to find areas around the country where had you purchased something and 20 years later sold it, that it hadn't appreciated. That's really unusual, really unlikely. So again, I'm not here to say that real estate will always appreciate no matter what, but it's a good diversifier from all the other things that people are exposed to. Now, if that appreciates again by 5%, now the value of the property is 551. It doesn't grow by another 25,000 because this is a compounding thing. It's now 551, 250. Now over 2 years, we turned 100 grand into 163. So we added $32,000 of wealth to our investment here in the second year. And in the third year, we added another 34,000. But look at that, in 3 years, so this is year 0, in 1, 2, 3 years, we basically doubled our investment from 100 to 197 in just 3 years, and I'm talking about 5% appreciation. So I doubled my investment even though the underlying asset only appreciated by 5%. That's a pretty good rate of return. And what have I not mentioned? I haven't touched cash flow yet. I've only talked about the equity so far. Now, equity comes in 2 forms, right? There's the debt pay down. I think of it like this because it's paying down that debt. And then there's the appreciation that I'm getting on top of it, all of which is mine as the investor. So those 2 things are responsible for doubling the money, even though the asset only appreciated by 5% in 3 years. And we haven't talked about the other 2 elements, which is cash flow, the one that everybody's aware of. But there's also a bunch of tax benefits, which shows up as a type of cash infusion, right? If you pay $10,000 fewer taxes than you might have because of a real estate investment, that cash is attributable to the real estate investment that you made. As far as I'm concerned, that's a return that my real estate investment gave me, and I want to count that because I wouldn't have that otherwise. It's a form of cash. So I think of real estate investing. The growth comes in 2 categories. Each category has 2 subcategories, right? There's the the equity, which is the appreciation and the debt pay down. Those both create equity. And then you've got cash. One of those is the income, and one of those is tax savings, which shows up in the form of cash. So this is a way to simplify what's going on in real estate because so many people are hyper focused on income. I see so many people saying, or just looking at properties based on income only, which can lead you down some pretty uncomfortable paths sometimes. You think about it like the best income position on a home is with no debt, right? So paying the whole thing with cash, but your returns are going to suffer because you're not using any leverage. Another example of this is if you wanted to just maximize income on a real estate investment, you would buy cash and you would buy with cash and you would buy in low rent districts because the ratio, we call that a cap rate in the industry, right? The ratio of income relative to the value of the property. The cap rates will be higher in areas where the properties themselves are depressed and struggling because it's harder that's a more difficult service and product to offer people. You've got more tenants moving in and out. There's more evictions. There's more the properties are older and it's a rougher area of town, you earn that income, right? And so sometimes people are hyper focused on income and they end up making mistakes, or they end up getting into positions that they didn't intend to because they're focusing solely on income. Where what I try to help people see is the whole package, the whole wealth principles that are going on, because there's a lot more moving parts than just the income. I know that's kind of a weird picture to show, but I saw that picture and I thought they look like they don't worry about money. So I'm going to use that picture on, on the wealth principles slide. So now this is that same shape as before, right? Where we put $100,000 down, the investment doubled. That isn't quite to scale, but the investment doubled over 3 years. And I want to show, I've taken the numbers out of here just to show the concept, because this slide gets kind of busy. But once you get to a point where you have enough equity to peel some of that off, now you can use that to go, buy the Corvette that you wanted. Oh, that was a weird choice of cars, I guess, or a boat. Or you could have that buy another investment. And now you have two investments compounding. And what you've done in the course of, in this case, 6 or 7 years, you've turned that $100,000 of equity in the beginning, and it's doubled twice now. Now you've got $400,000 of investment there on a $100,000 beginning, and you don't have to stop after two, right? It's like cell division. Each of these properties can create new properties, new investments for you, and there's no limit to how much you can purchase, other than the time and the willingness that you have to go and do that. Now, if we look at, so this is that image there, but if we look at our investment, right? We started with that piece on the left. We ended up, I had to shift it over there just so it would fit on the slide. But if we look at it in chronological order, we started with one, the one became two, the two became four. So we turned this piece into all of these pieces of equity. And I haven't talked about income yet or tax benefits. This is just the equity. Now, what I wanted to do, when the reason I got into this industry, is I wanted to take that, right? If we look at this piece here, that's understandable. But the way most people are used to looking at investments and numbers and money is on an XY graph, right? I started with this much. How much did I have as the years go by, and how do I calculate that as an annualized rate of return? And I kind of became obsessed with that, and making sure that that was a clear number for people so that they could compare apples to apples, so that they could see what their actual annualized rate of return was on their original investment, which is what we're going to do next. So I'm going to do a couple of examples. This is a couple friend of mine on the left. I'm hiding everybody's names here. I'm just using fake names. But that was a couple that I know. They're both professionals. They have a young family, or they did. No, this was only about a year and a half ago, so they're still young, the kids and all. But they were busy professionals. They wanted something just kind of turnkey. They wanted to diversify. They didn't want to, finish out a basement. They weren't looking to flip a property. They weren't looking at the Burr method. They just wanted to buy something to diversify. Julie was another example of somebody. She wanted to buy more real estate. She had a bigger budget. She was doing pretty well financially. And we have kind of a cool story about what she did. And then I'll talk about one that I think is a little unusual last. I don't want to give it away here, but I'm going to pull up these in that order. We'll talk about Lisa and Andrew first. Let's see. Okay, that's this one here. So this is the tool that I use to underwrite properties. Just the numbers anyways. There's other things to underwrite, like inspections and stuff like that, but just running numbers. This is a property that they purchased. I'll spend a little time on this pro forma just so we can go through the different elements, and we'll go through the others more quickly. But this was a property that they purchased for about $415,000. They put 20% down. It didn't need any improvement costs, so they didn't have any sweat equity that they got into it. They negotiated the closing costs, so they didn't have to, the seller paid for those. They put 2 points down on this loan. Non-owner occupied loans, they fluctuate quite a bit on how much they cost, but they put 2% down to get the rate and to get the loan in place. It rents for $28.50 a month. This is a townhome in Wheat Ridge. I always project something less than 100% occupancy, because I'm always assuming that eventually there's going to be an empty month or whatever. This is a cell that we can tinker with later, but this is asking, what do you want to do with the extra cash flow? Do you want to pay down the loan, or do you want to, reinvest it somewhere else and earn a return on it? I'm assuming that it's being reinvested here. That's why that's at no. There's the loan rate. Whoop. There's if there's a rate buy down, we can put that in here. That's less common on a non-owner occ building or a home. So that's not applicable there. Then the loan term is a 30-year loan. There's the taxes. There's the insurance. The insurance is relatively low because they've got an HOA. I'm generally, I get a little bit nervous with HOAs, not because I don't think it's a great idea. It's a great idea in theory, but so many of them aren't good with the numbers, good with the money. But the wife in this couple, she's a CPA, and she says, "I'm going to join the HOA to make sure that they're planning for things in the future, so we don't have these crazy special assessments and things like that." So they felt comfortable with the HOA because she immediately joined the board and helped with the financial part of it. So the HOA is a little higher than like a single family residence somewhere, but also the insurance is lower because the HOA is supposed to take care of things outside the drywall. The drywall in is your responsibility. They weren't paying any of the utilities; that was the tenant's responsibility. And for this is a number that is set aside money for maintenance and capital expenditures. And I do this as a percentage of the value of the home. And then this is a catch-all if there's any other monthly costs built in. There was nothing extra. This is just if there's some other monthly costs that aren't included here, we can throw them in there. They weren't having this professionally managed. I know that professional management is more complicated than a yes or no question, but the variables that determine how much that's going to cost are just on a different sheet here on the advanced. So this is where we put in management costs for somebody who wants management. This is kind of an interesting thing. I'll show an example of this in the next one because the next investor did use management. But I find it interesting to think or to talk about that professional management doesn't cost as much as most people think. I mean, certainly as far as dollars are concerned, they usually charge around 9 or 10% of the rental income. But people often subtract that from their expected rate of return. So if I'm expecting to get 15 to 20% rate of return on my real estate investment, and I pay the property management company 10, then that's going to leave me 10% or 5%. But it doesn't work that way because they're not charging you a percentage of your overall return. They're only charging you a percentage of the revenue. So it affects your rate of return significantly less than most people think. So that's an interesting thing to tinker with. So the cash flow on this property is only $11 a month. So that can sometimes feel pretty depressing for people who are focused on income. They're thinking, man, I put, in this case, $89,000 into this property between the down payment and some costs for the loan, and it's only cash flowing $11 a month. Why would anybody do that? Well, we'll show returns in just a second. So here's the appreciation that I'm assuming. So these are the assumptions for appreciation. I'm using 4.5% here. I'm using 3.5 for inflation. This is what affects things like maintenance, repairs, HOA, insurance, stuff like that. That's all creeping up by 3.5% over time. And I'm showing annual rent increase of 4%. And I'm showing the tax rate of this couple at 27%. So 22 federal, 5% state, roughly. Those are the assumptions that I'm using to create these models. This comparison rate, I'll come back to what that is. But these are the two major graphs that I like to show people. There's other things to look at as well and some other stuff, but this is I call this sheet, by the way, the dashboard. There's a lot of other things, a lot of advanced things that are populating the numbers here. But what most people want to see is the rate of return and the income. And if we look at this graph is set up so that the dark blue here is your equity position. The white is the cash that you put in your pocket, the accumulated cash. And then this red line is the combination of the two. That seems kind of unnecessary when these two things are stacked upon one another. But in some cases, if there's negative cash flow, the red isn't stacked on top. It's below the blue because the white would be pulling it below. I'll show you an example of that later. But they invested $89,000 today, and a year from now they've got, between the cash and the equity, 115,000. By year 5, they've got 275. By year 10, 557, as a combination of the equity and the cash that they've pocketed along the way. So remember that yellow cell at the bottom that was the comparison rate? That was set at 10%. This one here. What that is it shows what would happen if I invested that same amount of money and earned that rate of return on it. That's what this yellow line is tracking. So this yellow line is showing what would happen if you invested that money at 10%, and it's graphed here. The white and the blue and the red, I guess, is what your real estate investment did. So let's look at annualized rates of return. That's going to be over here on the right. So in year 1, in the first year, their rate of return, so they invested $89,000. There's that number again. By the end of year 1, they've got 115 and some change. That's about a 29% annualized rate of return. By year 5, they've got $206,000 of equity. They've put $69,000 of cash in their pocket along the way. That includes tax benefits, by the way. So that's the cash flow that's been piling up plus tax savings that they've gotten, which is a form of the rate of return. And then so the equity and the cash that they put in their pocket shows a $275,000 complete investment value by then, which is a 25.1% rate of return. By year 10, they're looking at 557, the same numbers that we saw in that earlier graph, and so on. Now this graph, this one's pretty simple. This is the one that most people want to see right up front, which is what's my cash flow? You start with 11 bucks a month. That doesn't sound too sexy, but the 25% rate of return sounds pretty sexy because it's not just income, remember. So this is just showing what I want people to see is, hey, this is what you can expect to clear on a given month when you don't have some outsized expense, and when you have a tenant in there, this is what you'll be clearing. One more variable that I'll turn on over here, one feature, is what happens if you put the extra cash flow that you're getting from this property against the loan. Then it will show, well, let's see. This one doesn't get paid off. I'm only showing 20 years projected here. But if we were, let's just tinker with a variable here. Let's say the loan is only at like 6.875. So, you know, it's going to cash flow a little extra. So maybe if that was the case on this property, if they put the extra cash against the loan, they'd have that property paid off in 18 years. So they invested 89,000, and 18 years later, they're cash flowing $4,521 per month. That's pretty attractive. So that's that one. It's a pretty vanilla case because there wasn't any maintenance to do, or not maintenance, but upgrades. You know, nothing to finish out. Not a burr kind of strategy. It was just a pretty vanilla turnkey investment. So we'll show another example. This one will be a lot quicker because we have. Let's see, because we won't go through all the elements like we did on that one because it's pretty familiar to us now. But this is an example of a bigger property. So this investor had about $400,000 to $500,000 to invest. And the agent was a pretty shrewd lady, a realtor that I really respect, and she helped this client find this. And you know, she got a $2 million fourplex. She put 20% down, but there was some improvements to be made. So not only she put about $10,000 ish. Wait a second, I'm getting that wrong. About $20,000 into the living area, right? The fourplex, the residences. But they put another about $40,000 into, this was in an area where they have the separated garages, right? There's an alleyway in the back where you access the garage and the property in the front. And there were only 2 garages, but it was zoned to have up to 6 garage units. So they built out 4 more and charged more because of that. And they ran some numbers and it made sense to do that. And they offered them to the tenants first, but if the tenant didn't want to pay extra, they leased them out as storage units. Kind of a clever thing to do. So they put about $61,000 into that. And because it created so much more cash flow for the property, it instantly appraised for $230,000 more than they paid for it. I say instantly, but it wasn't instant because it took time to build those things. But relatively instantly, they had $230,000 of sweat equity because they put this money into it. So they paid about $6,100 in closing costs. They put 1% on the loan, cost them 1% because it was non-owner occ. So now between the 4 units and the 6 garages, they were collecting $14,100 per month in rent. I'm always going to assume some vacancy when I'm calculating the annualized rate of return into the future. This one had a little bit of a higher rate, and there's the taxes, the insurance. There's no HOA. They weren't paying any of the utilities. Those were being paid by the tenant. We put a factor in there for maintenance and capital expenses, and I'm gonna turn on the property management in a second, just to show you how that affects the overall rate of return. So they were assuming 4.5% appreciation, 3.5% inflation, 4% rent increase, and a tax rate of also about 29%, 24 federal and about 4.75 state, and some change, something like that. Anyway, there's that same comparison rate. So if we look at her rate of return on this property, she put in about, we'll call that 500,000. Now she got a big boost right at the beginning because of this sweat equity. So that created a big boost right away, right? So this yellow line is just going to be that initial investment plus 10% after the first year. But after the first year, she got an extra 230 for putting an extra $61,000 of investment into it. Excuse me, this 500 includes the 61. So this is the gap that she received for putting that extra investment in there. By year 5, she had between cash and equity 1.7 million, and just off to the races from there. This was a fantastic, and actually not a very tough find. These, fourplexes are harder to find than single family residences, but they're not unheard of, right? They're out there. And this was a great find. So there's that. Here's the net monthly income. And then on the right, we look at these rates of return. Again, we won't go through those, each one of them, but you can see them. They're massive in the beginning because of that sweat equity, but it tapers off over time just because it's being blended into the overall return over time. So one thing I want to show here is how little the management is affected or affects the rate of return. So what I want to show here, they have a property manager on that property that charges 9%. They charge a 50% lease up fee. That means every time they have to replace a tenant, they charge half of the rent to send out advertisements, sift through applications, find a tenant. They charge 50% of the rent for that particular contract to replace people. And I'm assuming that we're going to project that this is being charged every 36 months. So there's about a 3-year turnover in each of the units. Now, obviously, that's not something we can know for sure in advance. It's just something that we have to estimate in order to get projections. So when I turn on the feature for property management, these numbers will kick in and start affecting the pro forma. And let's look at like the 10-year return. We're expecting 20.71 without management over 10 years. We change this to yes, and that goes to 20.01. So it went from 20.71 to 20.01. Like that's when you think about the value of good property management, it's so that you're never having to deal with that. Now it does affect your cash flow, clearly, but your rate of return is still fantastic because you're getting, so much of that comes from equity. In fact, this one is cash flowing negatively with property management. And a way you could fix that if you wanted to is putting, maybe 22% down. Nope, that's not going to do it. Let's maybe try 24, something like that. So now you're not cash flowing negatively. But there's all sorts of ways to look at this and ways to run numbers so that you make the best decision based on what you're trying to accomplish. So my point here is that the rate of return is a lot better than people think when you consider all the ways in which money is being added to the investment through appreciation and income and tax benefits and debt pay down. So that's that one. Now I promised one more, and this one's a little unusual, so it's kind of interesting. This one is, let's get the right one here. This one was a second home. So this one was, the family was staying in there some of the time and they were renting it out when they weren't there. And my whole point, I won't go through all the numbers here. My whole point, I'll just point out a couple things. Whenever I use a short-term rental, I push up occupancy to 100, not because I think it will be occupied at 100%. I know that it won't, but you can get the net figure from places like AirDNA after vacancy and after management expenses. We can find that number through various sources that aggregate data. So this number is not gross rent, it is net of vacancy and property management. So I don't attribute property management fees and I don't attribute vacancy because that's already baked into this number. So if anybody spots that, that's why. So in this case, this was a property up in Fraser, and it's really common if you're looking for a second home or a vacation property where you can take your family skiing or maybe a beach place somewhere. It's in resort areas, it's really tough to cash flow with 20 or 20% down because the prices are inflated because it's such a desirable place to have property. So in this case, this couple, they knew that going into it. This wasn't a surprise to them. They knew it was going to cash flow negatively pretty well for the first several years. And one option to fix that, if you really don't want the negative cash flow, is you can, just put more down. But in this case, they're already putting down 218,000. Maybe if you put 50% down, it would cash flow. Well, that would cash flow plenty, but you've got to come up with 429,000. So in this case, they've only put 25% down. I say only, but it's still a couple $100,000. And the way to think about this is negative cash flow. Now there's some differences. I'll point this out in a second, but negative cash flow is a really common thing in all sorts of investments. If I'm putting money into my 401k at work, is that negative cash flow? Yeah, like I'm spending it in order to get something in return. Buying an apple is negative cash flow. And buying real estate isn't negative cash flow isn't always the worst thing in the world. Now, I'll talk about some differences in a second. But the way they thought about this was, they in fact, in this conversation when we were going over this, he had just gotten a raise, and she said to her husband, she says, we were just talking about putting an extra $1,500 a month into the 401k. Why don't we just do this instead? And I, that's kind of a brilliant way to think about it. Of course, it's negative cash flow. I shouldn't say of course. If you're spending something but you're getting something in return, investments are like that all the time, just like everything else, right? A hamburger is negative cash flow, but we can still calculate the rate of return. And in the rate of return that I'm calculating over here, by the way, I am considering the negative cash. So I'm considering that opportunity cost. If you're putting cash into it every month, I'm subtracting that from your rate of return plus the opportunity cost that might be earning somewhere else. And you're still looking over well, let's look at a 10-year number here, 15.75% annualized rate of return, even though it had negative cash flow for several years. That's probably better than you'll get in your 401k over a 10-year period of time anyway. And what I love about this investment strategy is probably not the best. If you were just searching for rate of return, you probably wouldn't buy something in Winter Park or Fraser. Like the cash flow relative to the property price is kind of low. However, if you think of it in terms of a great way to live, I call this kind of investing lifestyle investing because it's a great way to have your cake and eat it too. You have a property that's performing quite well relative to other options, maybe not relative to finding that fourplex in North Glen, but if you're wanting a place to go skiing with your family, or if you want to go buy a place on the Mississippi River in North Carolina by the beach or Florida or whatever, it can actually make sense, even if it's negative cash flow, as far as a rate of return that's comparable, if not better than what you would expect in the stock market. Now, the one thing I said I would mention a difference between negative cash flow on real estate and negative cash flow in your 401k, because I don't want to be flippant about this. This is a real thing. There's two things that I'll mention. First of all, negative cash flow in my 401k is really easy to turn off. It's really easy to stop that, right? If I come into some financial difficulty in my life and I want to stop contributing to my 401k, that I get online and do that in a couple minutes and I'm done. Negative cash flow in a property like this is something to take a little more seriously because it's a little more difficult to turn off. So I don't recommend people buy a second home unless they can cash flow that negative amount comfortably. The other difference is that these are averages. So in a place like Fraser, that's a ski town, this is going to be an average. Some months will be significantly less than this. Think of like April and May. Not a lot of people are going up there to spend time and rent Airbnbs. But in December and January, it's probably positive cash flow. This is just an average throughout the year. So it's not just being able to comfortably afford this every month. It's being able to comfortably afford maybe even significantly less than this a few months out of the year. You'll probably make some money a few months out of the year. And then some months that are like, October, November, where people like going up there, but not as much as the winter or summer, you might be around this average. You just have to be aware that that's going to fluctuate a little more. And this is just an average. So, but as far as like living a good life and making money on your money, I love the idea of lifestyle investing, buying properties in places you like to go, spending some time there, and getting a rate of return that's very respectable. You guys have any thoughts, James, Toby? I'm about to wrap up here. I got a couple more things to look at, but that's basically, that's the tool that I use to underwrite these things. You guys have any questions or ideas or thoughts to share?
Love it. No questions.
It gets me so fired up. I'm like, I just want to share this with everybody. Like, it's just to open their eyes because it's you look at one thing separately. It's so different than when you add it all up.
Yeah, and I think, that answered the question. I think about this a lot. It answers the question because I was a financial advisor for a long time too. And what really got me started on building these kinds of tools was I wanted to know, like I thought I bought real estate as a diversifier, and I thought to myself, I wonder what my rate of return is on that. I don't know. And because no one ever really, I shouldn't say no one, but it's rare to make those calculations. And I was expecting it to be something like, 10 to 12% or something. But when I started tinkering all that, I thought, man, people need to know about this. There's more to it than just that. And so it answers the question that I think a lot of people ask if, they think if a financial advisor is telling me, I'm kind of beating up financial advisors, but I don't mean to. I just know that they don't talk about real estate very often. But if if I'm being if I'm being persuaded to avoid real estate and being told to consider other options, but I see people all around me making millions of dollars in real estate. Why is that? What is going on? Do they know something that I don't know? Is there something like, did they get lucky? That's sort of that Jill experience where she, I said that mistake that she made that last one, which is like, I guess I've got pretty lucky. In her example, that's her looking at her previous self and saying she got lucky. But it's also really common out there in the world for people to look at other people that have made a lot of money in real estate and say, that's not what's going to happen to me. They probably took a lot of risk. They got lucky. And it's like, no, that's just the way it works. And this kind of explains why people when they invest in real estate, they make a lot of money because there's a lot of money to be made. It's a very valuable asset. And another advantage of this, and this is stuff that you guys know well, it's so low on the Maslow's hierarchy of needs of what people need, right? We're not talking about trading Beanie Babies or GameStop stocks. You don't have to own stocks. Humans don't have to own stocks, but humans do have to sleep indoors.
Yeah.
Right. And it's an asset class that's really hard. It takes a long time to build more of. So very limited supply. It doesn't come online quickly. We're in a huge shortage of supply all across the country. And I just don't see, I can't imagine the value of real estate collapsing nationwide when there isn't enough of it and it's something that everybody needs. People keep talking about, well, I think it's going to crash because when things go up really fast, they must come down really fast. And what they're not considering is that, like, well, everything went up really fast because of inflation. When we pump trillions of dollars into the system, did you notice that apples and bananas and milk and eggs, those also went up tremendously because there's just so much more money in the system. So are egg prices going to collapse because they went up recently? Are apples going to crash because they went up recently? I shouldn't use apples because that's a common stock for people to buy also. But like, are the groceries going to collapse and are those going to be half price, sometime in the near future? Like, it's not going to happen because it wasn't this bubble that created that. It was just an infusion of trillions and trillions of dollars into the system. And it's just going to go buy stuff, raising the price and just diluting the value of the dollar. So, excuse me.
I
What
wanted
are
to
we
kind of,
looking at time-wise? Okay.
we're good. I wanted to just comment on the CPAs and financial advisors, knowing that, there's rules against them advising, right? When we kind of first started getting going, doing what we do, a friend of mine came to us and he's like interested in what we're doing with our rent to own model. And he looked at it and he's a smart guy. He's like, that sounds really good. He'd done some real estate investing a little bit. But he's like, let me run this by my financial advisor team. He had multiple people. And I was like, oh, well, that's never hear from him again about that. They gave the thumbs up. I was like, I couldn't believe it. But he had actually done some investing kind of outside their business with them. So that they already, his advisors were investing in real estate already. But yeah, they gave the thumbs up. Now he's done the most investing out of any of our investors, and off my preconceived thought that was never going to happen. So
Yeah,
cool.
you'll find that it's more common when you get into the higher echelons of people with wealth, because smart financial advisors, they know that their best clients are investing in real estate anyway. So they'd be shooting themselves in the foot. And well, I'm talking about two different things. They would be shooting themselves in the foot if they said, no, you don't want to do this. Because that client of theirs is not a dumb person. They're thinking, yeah, I've made millions of dollars investing in real estate. Like, you're just protecting yourself. And I don't think that's what these advisors did, because they were also investing in real estate. They were like, hey, that looks like something I'd be interested in, that sort of thing. So yeah, when you get them into that level of wealth, then things change a little bit. But that doesn't mean that I'm trying very carefully not to paint a broad brush or not paint advisors with a broad brush, because there's a lot of nuance to that too. There's some really good ones and there's some not so good ones and there's some really horrible ones. But there are also some really good ones, which is admirable.
Yeah. It's good
So just, we've been here about an hour and I've got a few more things and we don't need to talk about it. If we want to wrap this up, we can just cut to the end. So I'll kind of leave that up to you guys if you want to keep going.
Keep going.
All right. So a simpler way to think about this in my mind is these 4 different ways that we make money in real estate: the cash flow, the appreciation, the debt pay down, and the tax savings. I list them upside down here because I want to show a graph here that shows these. If we calculate on a particular investment, where the money is coming from each of those things. So this is an example of, a property or two, maybe a portfolio aggregated, where we're expecting some cash flow based on how much the value is worth, what we're expecting on appreciation, debt pay down, where the money's coming from, because the total of those things is what I want to know. What am I expecting for the next year, or what did I achieve last year if we're looking backward? So if we look at the numbers on this particular portfolio, the properties are worth $1.2 million, purchased it at 651. The loan value is currently 376. That means there's $857,000 worth of equity. It's cash flowing just under $2,000 a month. I'm going to assume 3% appreciation on this property over 1 year, just so I can project what my return will be on the next year. And we're going to introduce a concept here in a second that's really important here. And then how much debt is going to be paid down in the next year on this property, because that's equity too. So we're expecting total wealth increase of $76,000 based on this portfolio of 2 properties. I think this was when we did this, 2 properties in the client's portfolio. Now this is a really important number that I think not enough people outside of high-end real estate investors take into consideration: the return on equity. This is a really popular number when analyzing stocks. But in real estate, I don't see it as much. I'm starting to see it more and more, which I think is good. It's a very important metric because in many cases, people will look at their original purchase, like let's say 651, and they'll say, if I earn $76,000 on my original 651, that's amazing. That's like what, 12, 13%, something like that. Maybe something like that. I'm getting close to that, I guess. They'll think, man, it's great. I only put, and that was just the purchase price. If you talk about my down payment, which was probably about 300 grand on this, I'm making a lot of money based on my original investment. But in finance, you never do that. You never count your original investment. You count, because if this is a few years later after these properties were purchased, it's the equity in this property. That's my wealth. That's the wealth that I'm in charge of today. I'm a steward of that wealth. So the $76,000 should be a percentage. I want to calculate that as a percentage of this. It would be the equivalent of saying, if I bought a stock portfolio for $100,000 10 years ago or something, and let's say it's now worth 200 grand or 300 grand, and it earns, I don't know, 10%, it earns 30,000. It would be the equivalent of me saying I earned 30% on my original $100,000 that I invested 10 years ago. Nobody ever does it that way, and for good reason, right? I had $300,000 that earned that 10%. That's what that meant. That's my return on the equity on my investment that I had at that time. So if we calculate the return on equity, there's those 4 elements. I kind of skipped that language. But I had a return on equity of 9%. I had $850,000 invested. I added $73,000 or 76, or I was expecting to in the next year if I got 3% rate of return, which is only about a 9% rate of return, that's not bad, by the way, but it's not exceptional. It's okay. And so here's an example where this is the new scenario. So this is what we recommended to the client. Okay, now instead of having the $1.2 million, let's take some of that equity out and go buy more real estate. And it will give you control of more real estate. You'll have more loan on the property, but you'll have a similar equity. This is what you had before. It's going to cost you some equity to do this, because if you sell something and buy something else, there's some transaction costs. So we are assuming that you're giving up some equity to do this. And it's also going to dip into your cash flow, because you're adding more debt to the portfolio as a percentage. Like, you're taking some of that equity out and going to buy more real estate. So you're going to dip into your cash flow today, but we'll see how this plays out. Right? This is something that would make people nervous. Why would I lessen my cash flow on a real estate portfolio that's doing okay? And we'll talk about that, because I started with this much equity, but I'm expecting to add this much through those 4 elements. Right? Now my appreciation is significantly larger, because I'm earning an appreciation number, 3%, which I think is conservative. on a $2.5 or $2.6 million portfolio. So my wealth increase jumped significantly. Remember, it was what, $76,000 in the last example, and we just used the same portfolio. We just shuffled it around a little bit so that, because we're trying to maximize all four of these, not just the cash flow. So there's those four elements. And the total of the four is something significantly more than it was before. And here's those two things side by side. So there's the original portfolio on the left. There's the next portfolio. So you'll see the green, the cash flow has dipped a little bit. And we could have even gotten more aggressive and taken more of the equity out, which would have dipped this even further. But this is what the client was comfortable with. So the cash flow diminished a little bit, but the appreciation is significantly higher. The tax savings is significantly higher. Looks like the debt pay down is slightly smaller. That will increase over time as the loan goes from less principal to more principal as it's paid down and amortized. But the overall wealth creation is significantly more in scenario 2 than in scenario 1. So it went from, on the same portfolio, went from an 8.9% expected rate of return over the next year to almost 14. An additional, what is that, 40, an additional $40,000 of wealth created on a pretty conservative 3% appreciation estimate. And the reason for that is because we have these return on equities that are diminishing over time. And the reason that happens is because we're getting less and less leverage working for us as we go, right? And it's not just because the debt's getting paid down, but even appreciation means we are losing leverage because the dark blue becomes a bigger percentage of the overall value of the property. Real estate just delevers naturally as it exists. So I'm not saying that you should do this forever, because ultimately you do need to focus on income eventually. Otherwise you can't retire. Like you can't always sacrifice your income to use that equity to go buy more properties. But if you have time on your hands, you should consider that, because it produces much more wealth that way. So sometimes people will argue between, should you focus on appreciation or income? And I think that's a bad question. It's really more of a nuanced topic where you should create like a glide path. You should figure out when you want the income, or make your best estimate to when you want the income, and maximize it for that time. So here's an example. Well, I'm going to skip this slide. Here's an example of that. So the blue portfolio was the one on the left that we were looking at. The yellow one is the new one. And this red line represents the goal that the client was trying to reach, which was $10,000 a month, so $120,000 a year. Now, if they were to keep that blue property, it would eventually get there with rent increases and things like that. And as the debt got paid down, it would eventually get there. However, by making this change and sacrificing some income now, remember we went from income of about $23,000 a year down to 13. But by doing so, now we're controlling two properties and the debt's getting paid down on two properties. Now the income that really we want to focus on eventually, right, when we need the money, is on a much steeper curve. So we sacrifice some now so that we could have more later, or you could think about it as hitting my goal significantly earlier. So if my goal was $120,000 a year, I saved myself about 17 years in getting that by making that small adjustment here. And that 17 is just an estimate, because I'm trying to decide where this blue line is going to cross that $120,000 mark, somewhere out here. But that's about a 17-year savings in that goal just by using equity to go acquire more real estate. So that is the end of the topic. I went through that last stuff pretty quickly. Hopefully that was helpful and additive to the conversation here.
Yeah, that's brilliant.
Yeah,
Thank
that's super powerful, Brady.
Yeah.
Anything else worth chatting about before we call it a night?
Yeah, it's just good to see the end picture there. By putting that equity to work in a different way.
Mm-hmm. Yeah, we've been talking about the return on equity quite a bit recently.
Yeah, it's a really important thing to note. And again, it's not like if I'm 80 and I want to sit on the beach and collect, rental income, then that's not the game to play, right? But the idea is don't overemphasize income when you need it, or when you don't need it, rather, excuse me. But like if you have, I meet a lot of people that are maybe, I have this example. and it's pretty representative. I see something like this quite a bit, but I know this couple that has this property that they love. It didn't cash flow much when they bought it, but now it's cash flowing like $1,800 a month and they love it, but they're in their 40s. I'm like, maybe let's look at this and let's try to maximize your income when you need it. And they're both working, so they're not trying to retire early. They like their jobs. And the idea is like, hey, give up some of that cash flow now. And that's really difficult in today's environment to swallow that pill, because you're also talking about taking a mortgage that's maybe at 3% or something like that and refinance things and get equity working for you. And that loan might be at 7% or something like that. And that's hard for people to swallow, but we can still run analyses and show, yeah, I mean, it's one thing. I would rather be paying, I also would rather pay 3% on debts than 7%. Sure. Like that when you isolate just that number, yeah, the lower the better. But that's kind of the tail wagging the dog, because if you have hundreds of thousands of dollars in equity that's doing nothing for you, because you're going to get the appreciation on that house, whether you have $1 of equity or $0 of equity or all of the equity that's there, right? If you have no debt, you're going to get the appreciation on it anyways. If you have a bunch of equity in there that's just doing nothing for you, that could be redeployed because you have time before you need the income, that equity could be earning 15 to 20%, as we saw in those earlier pro formas, and it's earning nothing, right? That's a much bigger difference between percentages than the 3 to 7% increase that I'm going to take on the loan, right? So that's a 4% difference, which again, I don't want to pay more on debt than I have to, but I don't really control that. I think of bank money like gasoline, right? It's so valuable that we sort of, when people drive across town to save 5 cents on a gallon of gas, it's like, well, okay, whatever you need to do. But if gas costs double tomorrow for whatever reason, if it costs double everywhere in Colorado, when I pull up to the gas station, am I going to even consider not putting gas in my car because it's just too expensive? Like, that's crazy. Gasoline's probably worth $15 a gallon to me. I'm glad it's only 3 or less, but it's so valuable. And I think of bank money kind of like that. Like, they're going to charge what they charge, but it's so valuable to use that leverage and go get things. We sometimes get focused on the things that are easy to focus on, like interest rates, but there's so much more at play. Investors are still buying real estate because they've learned to, not get hung up on that.
Yep.
Yep.
Man. Thank you
All
so
right,
much.
guys.
I can't wait to share this with other people. So
Well, thanks for having me. Thanks for setting this up. It was good seeing you guys.
yeah. And for
likewise.
anybody watching this, Brady's a lender. So if you're looking for loans, use
Yeah,
Brady.
we do all sorts of stuff for homeowners, investors, and everything in between.
Yeah. Cool. We can add your contact info. People can reach out to us for it. So
Super.
awesome.
Well,
Thank you
thanks,
very
guys.
much.
If there's nothing else, we'll call it a night and go relax.
Yep. Perfect. Thanks.